Okay, good afternoon, everybody. Thank you for joining us. Alex Chisnall here again from the Festival of Startups. We are on day 2. This is our 4 p.m. session, and I'm delighted to welcome my friend John Auckland from Tribe First. How are you doing, sir?
I'm very good, thank you. Much better than last week.
Indeed, yes. We had to reschedule that, didn't we? You
yeah.
came down with it, just like I did about 3 weeks ago. I got a negative. You got a negative.
Yeah, all good.
Good man. Okay, so thank you everybody for joining us. Got all sorts of emojis flying up in the air there. See, people have found their emoji button. So welcome to this platform. As I say, day 2 Festival of Startups. Most common question I'm getting asked is, where are the replays? So the replays are, I'll post up a link as well, actually, folks. If you go to Festival of Enterprise website, there is a button that says past webinars, and we are uploading those as quickly as we can as we get them from Airmeets, which is this platform that we're using. Likewise, as soon as we finish today, so about 24 hours we're finding, so you'll be able to watch John's tomorrow if you're unable to watch it live today. And likewise, if you know anybody who is going to be interested in this topic, then again, send them the link that you've got here. Send them that link and they can watch a replay as well. So, so a little bit of housekeeping before John gets going with his webinar today. We are talking crowdfunding. So John's been a specialist in this area for a very long time. He's been sharing some tips on getting crowdfunded. Going to cover a bit, I believe, on the Crowdcube and Seedrs recent merger, if that's going to happen. Is that going to happen, John?
Wow. Watch on and you'll hear my thoughts on it.
Good. Piers Linney was chatting about that last Thursday, actually, when I had him on. He's quite interested because he was just what is his role? I think he made him co-founder of Atherton Bikes, and they just raised 1.2, 1.3, I think, and doing pretty well. And we're just trying to work out how much of kind of overfunding they wanted, how much equity dilution. And I'm sure you'll cover that kind of stuff. But he was super interested in it and whether that merger goes ahead and what's it mean, etc. So exciting to hear your thoughts on that as always. I can see people piling into the webinar as we speak, which is awesome. So thank you all very much indeed. If you'd like to interact, literally, if you've got comment on what John and I are talking about, if you've got a question directly for John or myself, 2 ways you can interact. If you look at the right-hand side of your page, you've got right down towards the bottom, you've got a questions tab, and I'll be able to see those questions directly. And then you've got a live chat button as well. So you can comment in there. You can also post questions in there. That's cool. And also, post up any links, like a LinkedIn profile, so you can connect with people on here as well. And then in between each session as well, in case you didn't know, there are live tables, networking, connecting tables. You just need to head back to the lounge to interact with other people. And there's people on those tables pretty much half an hour before, half an hour after each webinar. And then I'm going to be back again tonight, 6:30. Networking will open again, and then I'm going to be live with Laura Di Benedetto from Hawaii at 7 p.m. Wish I could go there. It's getting dark already outside. I'm just looking out.
I was going to say, Olney's not quite as exotic as Hawaii.
Indeed no. Okay, well, look, I'm going to hand over to John. As I say, he is co-founder of Tribe First. He also runs a crowdfunding accelerator with Virgin Startup and some other interesting organizations as well. I'm sure he'll tell you a little bit more about that. But I'll let you bring your slides up, John, and I'll hand over to you.
Lovely. Thank you very much. So, hi, everyone. Thanks for tuning in. So, as Alex started to intimate, I am a crowdfunding specialist, for want of a better word, although more accurately, I'm probably a copywriter that specializes in the crowdfunding sector. Equity crowdfunding specifically, we do some rewards crowdfunding, but equity is kind of our is kind of our mainstay. And so the big news in the crowdfunding world, of course, has been this talk of a merger between Crowdcube and Seedrs. There's other big news coming from the States as well. They've opened the market up, increased the allowance of equity crowdfunding to make it much more like the sort of limits in the UK market. So I'm going to talk about some of the trends, I guess, in the crowdfunding industry. But what I really wanted to do is look a little bit deeper before I do that at what is kind of driving these trends. So, what does the global and UK private equity scene look like? What fundraising options are available to companies? What route does a founder tend to take to kind of reach that exit that they so desire? Explore, I guess, what has kind of led to this merger and why potentially it's quite necessary. And then we'll do some Q&A sort of things at the end, if that's all right. So first of all, Tribe First, my company. Why is it called Tribe First? I think something sort of quite fundamental is happening in terms of the brand and consumer relationship. And this is, if you go right back to the sort of start of internet technologies and as it was dubbed Internet 2.0, which probably came around in its true form about 10 years ago. Obviously you had the internet, and then you had these new internet technologies that allow people to kind of interact much more socially. And so that has completely changed the relationship that people have with the brands that they love. And so they want deeper, more meaningful relationships. And so it's a logical next step that they would then want to own a part of these companies and be part of their journey and share in some of their success. So equity crowdfunding, in a way, is actually a symptom of that change. It's not often the market that drives change. The market reacts to change. And so at a kind of deeper level, that's what's been happening with the crowdfunding market. So we kind of explore, why that's kind of led to where the market is today. But it's also, it's why I created Tribe First. I saw this opportunity to, bridge the world of fundraising and marketing. And equity crowdfunding is a great place to do it. It's not the exclusive way to do it, but it's one of the better ways to do it. Where, companies can get money that they need to sort of drive their ideas forward if they find enough people that believe in them. And to me, that's connecting with your tribe, and your tribe then powers your kind of growth and what have you. So first of all, what I'm going to do is I'm going to take you through a story of two companies that I think engage their tribes in very different ways at very different times. Grocery box home, meal kit delivery box companies. HelloFresh, they were the first. They invented this new category, which is so familiar to so many people today. But of course, in 2012, when they first entered the market, the industry didn't exist. And I was brought in to run their social media. So it was one of my kind of first startup marketing experiences, if you will. And at the time, they'd been using interns to run their marketing function. It wasn't particularly sophisticated. They were very well funded. They were funded by Rocket Internet, which, if anyone knows Rocket Internet, knows that they kind of incubate e-commerce style technologies. And so HelloFresh kind of sat within their sort of investment thesis. It's a very early stage sort of venture capital backed business. And their marketing was fairly poor, to be honest. I mean, brilliant company, but they had a really defined tribe that was trying to engage with them. You looked at their social media channels. You had these people being really vocal, communicating with each other about doing things like cook-alongs. And yet HelloFresh wasn't tapping into that. They were being very passive and just sharing content. And it was the wrong kind of content as well. It was things like puppy photos, or they'd take a picture of a lottery ticket, and if that lottery ticket won, anyone that liked or shared that post would get a share of the winnings. It was really kind of clickbaity stuff. And they'd done loads of sort of demographic research. They knew their audience very well. They knew them to be very time poor, but aspirational, experimental, and actually relatively well off. So of course, that kind of content they were sharing was appealing to the antithesis of their audience. So we went in there and just kind of fixed things, changed their content strategy, did loads of live cook-alongs, took all their historic recipes and put them into recipe books that you could download. Pretty simple, fundamental stuff. And it was around the time that Gusto had gone on Dragon's Den. So there was the danger that Gusto, the second mover, was suddenly going to come in and overtake HelloFresh. And so, if we hadn't done that work, I genuinely think that Gusto would have probably caught them up and overtaken them. But as it happens, HelloFresh kind of won the race. They made it as first mover. They made it to their IPO first before anyone else did, and it made them a $2.6 billion market cap company, which is insane. It's massive. And they become a true disruptor to the sort of bricks and mortar supermarkets. But it just, it was an interesting time to see. I didn't realize it at the time. It was only looking back at it that I was seeing, a company engage with their tribe probably for the first time, and it was really around the sort of start of the last decade that this was starting to happen. Of course, this is what led to crowdfunding being a success, a meaningful way in which companies could raise funds. So on to Mindful Chef. So they were founded in 2015 by three friends from Exeter University. So they were very late to the game. The category had been sort of established by this stage, but they were able to look at what the likes of HelloFresh and Gusto did, and kind of have a bit of a late mover advantage and just create a better user experience for their audience, and also just have a bit of a niche. So they went to the kind of ultra healthy side of things. They were the first ones to introduce vegan meals and vegetarian meals, and just give more flexibility to the user in terms of what they ordered. Now, because they were so late to the party, they ran 3 successful crowdfunding campaigns as their kind of user base ramped up. And I genuinely believe, had they not run 3 equity crowdfunding campaigns, they wouldn't have been the success they are. And it's quite poetic, really, because they're actually the most recent equity crowdfunding exit. Only last weekend, we got the news that they were bought by Nestle. And Nestle, obviously, historically has had quite a bad, brand, really, when it comes to, demonstrating the provenance of their food, just generally sort of, bad business practices, if you will. And of course, Mindful Chef has got this incredible halo effect. And so it was a very clever strategic buy on the part of Nestle. And I don't think that Nestle would have bought them purely for their revenue. The revenues comparative to what Nestle's are pretty. I mean, they're going like this, as you can imagine, in the pandemic as well. They've absolutely flown. So not to sort of take away from what Giles and Miles and the team have done, but it's they bought them because it was a strategic thing to do. It was good PR. So the most recent crowdfunding success, has been because they engaged their tribe in very different ways. So it's kind of, there's no right or wrong way of doing it. One went down the venture capital route, the other one went down the equity crowdfunding route. But ultimately, they were both successful in their own way, and made the best, I guess, of the resources they had. So what I'm going to do is kind of link back to the fact that equity crowdfunding is not the only way of raising funds in your journey. If it is right for you, it's a very advantageous way. For Mindful Chef, it was good for them because it meant that they could start to build a bit of a tribe. They had they did a study of all of their customers and surveyed them and asked them how, have you referred via word of mouth? And the interesting thing is a normal customer versus a crowdfunding customer, so an investor that then became a customer, they were 450% more likely if you were an investor in the company to refer via word of mouth. So that's tangible benefits, that's measurable benefits as to kind of recruiting this army of ambassadors that's going to go out there and shout about you. And there's been lots of, late movers into this market that have tried to create recipe boxes and have failed. And Mindful Chef succeeded because I think they were so successful in their equity crowdfunding campaigns. So I think that was a very interesting point to make. So what is a typical fundraising journey look like for an entrepreneur? And I know that a lot of you are kind of at very different stages in your journey. So I don't want to kind of mull over this for too long, but if you're just starting out, you'll be bootstrapping your idea. You need to take it from an idea that's in your head, a pitch deck, maybe that might be as far as you've kind of got with it. Realistically, you're going to have to bootstrap to the stage where you can at least do some kind of paper pilot or prototype. And that sort of 0 to 5K sort of level, that's going to come from your own money. You know, maybe a friend or family would sort of invest at that stage. Maybe you'd get an early grant, or maybe you'd apply for like a Virgin startup loan or a Street UK one, these government-backed startup loans. And that sort of area really should take you right up to the to the pilot sort of stage. You can still be pre-revenue, but you know, you've done a lot of the kind of risky stuff around the R&D. And that's when sort of external fundraising opportunities start to kick in. And what's interesting, you'll see just how much, I mean, I didn't create this, just to clarify. I'd probably move some of these lines around personally, but this comes from Grant Thornton, who's one of our partners. We have historically run crowdfunding boot camps with them. So this is kind of their sort of research or thesis on the fundraising landscape. But it is a journey that most startups will take at some stage through one of these different paths. But you'll see that, you know, to the right hand side, there is so much crossover in all these different areas. And I guess what it's showing you really is that they are so interdependent. You can't just go equity crowdfunding without some of these other things. You know, you need angel investors to come in and cornerstone the round in order to validate it really for the retail investors, to give them the confidence that they need, but also just to kickstart the whole sort of momentum of your equity crowdfunding campaign. Or it might be a family office or an early stage VC that comes in as well. And then to take you on to the next stage, you know, we're starting to see, and you'll see on the next slide, you're starting to see some much bigger raises start to happen via equity crowdfunding. Companies doing their Series A, B, so in some cases even their Series C, they're now also leveraging the power of the crowd because they recognize that benefit of tapping into you know, these kind of network effects of and brand ambassador benefits of equity crowdfunding. So we've seen the likes of you know, Moneybox, What 3 Words, you know, very, very kind of late stage company, VC backed under multiple rounds, and the VCs are coming in again on this round, but they're holding some back for the crowd. So we're seeing much more of that, you know, even right up to, you know, crowdfunding even into overlaps with, you know, the private equity markets to some degree. And I guess at this end here, this point at the end, that's where you start getting your kind of exit or your sort of acqui-hire or much later stages that aren't covered by fundraising, then your established business, and then it's more about unlocking value that you've already created in the business. But the key point is they are very interdependent and very interlaced, and it's almost impossible to kind of pull them apart. As I said, these are some of the big campaigns that we've seen in the last 12 months. You'll notice here, some of these have taken place this year during the pandemic. You know, Moneybox, What 3 Words, they started their campaigns during lockdown. Moneybox got 16,700 investors into their campaign. You know, it's insane numbers of investors. So, you know, the appetite is there for retail investors to invest. These are customers first and foremost that love these brands, and crowdfunding is, you know, it's becoming much more a place where these big brands already have a huge community. They can tie them in even more and make them feel even more passionate about their brand before they go on and do a public listing and they sit in the public markets. And it's, you know, heartening really that equity crowdfunding has proven that it is recession proof. In the early days of lockdown, the market did die right down, but that was purely because the companies weren't going on there, because the founders wrongly thought that investors wouldn't be investing anymore. And as soon as the confidence on the founder side started coming back, you know, the investors started coming on and investing. And of course, a lot of investors took a hit. You know, their other investments, so they might have been shoring them up because they weren't doing so well, or, you know, they might have owned businesses that had suffered. But for all those people that had suffered, there were people that had benefited. You know, they certainly on the retail investor side of things, you know, you'd have been going on holiday before and buying clothes to go out and going out. Of course, you're not doing any of these things anymore. So retail investors actually invariably had more expendable income. And it's important to remember that equity crowdfunding, it does tend to be expendable income that people use to invest into these companies. So on to the kind of big news, Crowdcube and Seedrs merging. And what has that done to the landscape overall? Obviously, there were fears. I mean, it's not been ratified yet by the Competitive Markets Authority. So that's the process that's going through that it's going through right now. And of course, the question comes down to: is equity crowdfunding within itself a market, or is it a subsection of a much larger market? And of course, you know, you can look at it two ways. It can either be equity crowdfunding is UK equity crowdfunding market amongst the global equity crowdfunding scene, or you can look at it as being a relatively small part of the total sort of private equity fundraising market. So I'm going to do a kind of side-by-side comparison. The easiest way of doing this comparison, by the way, was by number of deals, because of course you can have number of deals, you can have total amount raised, or you can have you know, revenues that have been generated by these companies, and they're all meaningful in their own way. But to me, the number of deals is probably the most important, because that's the number of companies that have successfully achieved their goals that are being serviced by these service providers. So I think it's the most useful metric to compare. So on the right, you've got Crowdcube. This is a bit of a misnomer. It looks like Seedrs is the bigger platform, but actually this is, you know, in terms of number of deals, Crowdcube did 123 million in terms of revenue or investment banked for these companies, versus Seedrs 99 million in this time. It's just that Crowdcube did it across fewer deals. So they kind of spent more time on each deal, some of them being larger. But you can see they're a relative parity in terms of number of deals. Now, if you compare them to the equity crowdfunding market in the UK, you can see they dominate. Only 18 more deals were done outside of Crowdcube and Seedrs in 2019. And so this is the bit that's going to cause some controversy, because, you know, some people are going to say, well, hang on, you know, they are two dominant players in this market. They merge, they own this market. However, when you compare them to the total private equity market, all of a sudden it becomes much more realistic, or a picture of what's actually happening. You know, companies, you compare those two again, HelloFresh to Mindful Chef, you know, they both went down different routes. Both of them worked for both companies. They both got what they wanted to get. One went straight down the venture capital route. The other one went down the equity crowdfunding route. There are options to these companies. And actually that equates to only, if you count it by number of deals, Seedrs and Crowdcube combined, according to Bowhurst, led to just 24.21% of total private equity deals in the UK in 2019. But now what's really interesting, if you change that metric to total size of the market, you're only talking about 1.91%, because I can't see my notes because my notes are hidden in these slides. But I think it was 212 million combined raised by Crowdcube and Seedrs. It was 11.75 billion. Sorry, 11.75 billion that was raised in the private equity markets in 2019 in the UK. So Seedrs and Crowdcube combined only equate to 1.91%. As you can see, it's a tiny percentage. So this is the argument that the platforms are going to be making as part of their merger to the CMA. We are a tiny, tiny part of a much, much bigger market. They're also going to argue that there's lots of other alternatives, and so, you know, there's if it's not going to take away choice to the entrepreneur, because, you know, arguably they are as big as you know, Crowdcube and Seedrs are as big as they are because just the way they kind of entered the market. You know, Crowdcube came in first. They entered in 2010, so just a couple of years after the last recession. So they were born out of the last recession. And they were born because there was very little opportunity for companies that were starting up to raise money. You know, gone were the days that you used to go down to your bank and your bank manager would lend you the money. You know, there was a severe sort of funding gap for UK startups. And so Seedrs came along soon after, and about 2 years later, although they say they had the idea before Crowdcube, they entered the market after Crowdcube. They were the first regulated platform, but their sort of paths, sort of whilst running parallel, they were very, very similar, and they kind of grew at a fairly similar pace. Crowdcube had the slight first mover advantage, but they grew, you know, pretty similar trajectory. And so some of these other incumbents, you know, approach the market in a very different way, but they're completely viable options for companies that are looking to raise money. So Angel's Den, for example, is a much more of a kind of angel investor platform. What their model is, they kind of match you with one angel, and as soon as you're matched with one angel, you can then open up to the whole platform. And they've got thousands of angel investors on there waiting to invest. That's a perfectly viable option for companies that are looking for perhaps more smart money to come from angels that can sort of support them on their journey and fill in their skills gaps, maybe that exist within their sort of founding team. You have Angel Investment Network, which does actually it's an unregulated platform, but it allows anyone to sign up as long as they kind of, sign all the disclaimers to say, I know if I invest in any of these companies, I'm going to lose my money. It's not a regulated marketplace, but it is a shop window into the private equity scene in the UK. And anyone can list on there. And actually, a lot of the companies that go on Crowdcube and Seedrs do still go on Angel Investment Network. So, you don't have to go on Crowdcube or Seedrs, or the new super platform, whatever it's going to be called. There are alternatives. Once you have 20% of your round filled, you can go on. The UK Business Angels Association has a deal share platform. So up to 13,000 UK business angels are on that platform. It's where they congregate. It's where they get their knowledge. It's where they kind of go to events and they share knowledge and share ideas and share deals. And so, that's a great place for a company to go and, if one of your angels or one of your investors, is a UK BAA member, they can nominate you for that deal share platform. And if they're not a member yet, get them to sign up to become a member. They'll probably benefit from it anyway. So that's another option. And of course, you don't have to raise via equity either. You can raise via debt. So the likes of Funding Circle, great sort of peer-to-peer debt platform is another option as well. So it's just another sort of tool in the arsenal of a founder that's looking to raise liquidity to meet whatever business challenges they have and grow. There's other B2B platforms as well. So some of you may be familiar with some of these platforms, some of you may not, but Seed Legals is now the UK's best SEIS and EIS, the most prolific SEIS and EIS service provider. So doing applications on behalf of companies. I'll come on to SEIS and EIS just in case some of you don't know what it is. I'll briefly touch on it, although that's not the subject of this webinar. So Seed Legals provides all of the kind of legal services that any startup might need to back up their funding round. So of course, one of the benefits, of course, of the equity crowdfunding platforms is that they sort of consolidate all of the investors into one nominee, and they make the legal framework around a fundraising round much simpler. So a lot of your money, and this is what entrepreneurs kind of fail to realize, a lot of your fees with Crowdcube and Seedrs at the moment are tied up in that kind of legal and compliance process, that consolidation process. So Seed Legals have approached that in a slightly different way. They've automated a lot of it, similar to how the platforms have done. So actually, whilst you can't run the financial promotion on there, you could promote perhaps on say Angel Investment Network, but close your round actually on Seed Legals. You can you can pick and choose the various different things that might suit you as a business, and it might even be more affordable as well than using Crowdcube or Seedrs. So there are other options out there, and they have various products like Seedfast, which allows you to very quickly raise money and automate the process of sending out term sheets to investors. And they have other things like advanced subscription agreements, so you don't actually need to fix a price. You can kind of kick the valuation down the road. So loads of really cool, very, very clever technical tools that founders can leverage. Investors is another great platform. So if you want your own white label platform, you can use Investors. So that allows, if you have a large community already, it allows you to have the regulatory sign-off completed by investors, and to run your own campaign effectively, with all the back-end stuff being kind of dealt with by investors. So again, it's another option for, and often can be a lower cost option as well. If you've got a large community yourself, you can actually probably save a bit of money by using Investors. And then there's a kind of B2B platform, Delio. There's various others, which is more of a white label platform for other companies that want to be able to run their own platform. So it allows, and this also works on Investors. It allows companies, if Tribe First wanted to, not that we have done, but if Tribe First wanted to, we could have our own platform. So it allows anyone to come in and be a challenger to whatever this new sort of super platform is going to be called. And then of course, you've got the private markets, private equity crowdfunding, and the gap between the public markets such as AIM and FTSE, and London Stock Exchange, they are getting smaller all the time as well, again powered by technology. So there's a new player into the market called Aquis. They acquired Nex, which was a kind of challenger stock exchange. So it's a licensed stock exchange in the UK, and it sits directly between, say, AIM and equity crowdfunding in terms of cost. So again, this is a new challenger that's kind of entered the market recently from this direction. You can't see my arm, but I'm pulling it from the right to the left. That's making it more affordable to become publicly listed. So that opens up these much bigger institutional investors from being able to invest into these growth companies. And you can and it does two things. Then it creates new liquidity for these companies, but it also unlocks value as well for people that have been involved in the early stage, be that early investors, be that directors themselves that want to de-risk their lives a little bit, or be that employees that have been paid in equity, because we know that's the reality of companies that are starting up. Often you have to pay your first employees via equity, and at some stage, that needs to be they need to liquidate that to be able to earn a living. So I think, the TLDR, there are lots of options, and whatever this new super platform is going to be is not the only option. It's a great option, and obviously we're massively biased, and we think it's great for a lot of companies, but it's not the only option. And then let's look at it sort of globally. Both Crowdcube and Seedrs have sort of forayed into the global equity crowdfunding market with various sort of degrees of success, depending on which country they've entered into. Portugal, for example, Seedrs was co-founded by a Portuguese national, and so they had all their development out there, had an office out there, and so they really sort of tackled the Portuguese market quite early on. And Seedrs had a sort of similar, Crowdcube, had a similar success in Spain. They had a Spanish office and had a dedicated platform in Spain before they ended up merging the platforms. They've both run campaigns for US companies, for they've Benelux region, for Iberia, for some Eastern European campaigns. So they are already global platforms, but I think this merger between the two is going to really give a chance to be really established on the global stage at a time where other players are starting to spring up, new entrants into the market. So Investor's been around for a while. They're a Finnish platform. They kind of cornered the Scandinavian market, and they've kind of moved into other parts of Europe. Eureka is an FCA licensed platform, operates predominantly out of the Emirates, United Arab Emirates, but does also service other parts of the Middle East, and also UK companies that might be looking to establish a foothold in the markets there. Then you've got the New Zealand and Australian platform Equitize, which started in New Zealand, which relaxed the rules slightly sooner than Australia. And then On Market as well, which is another new start in Australia. And then you've got the four main players, although there's lots of kind of startups in America, as we did have really in the early days of the UK scene. They're a few years behind us because they only really opened up the market about 3 years ago. And it was only this year, as I say, very recently, that they opened it from a $1 million raise limit to $5 million, which is much closer to the UK and European regulations. So they can do true equity crowdfunding there now. And so there's an opportunity for the new super platform to, be a global player. And of course, that's probably what we want in the UK, especially with everything that's happening with Brexit and the post-coronavirus recovery. Whichever side of the Brexit divide you sit on, you want the British economy to do well. And so, their combined efforts, I think, will mean that they can become a much stronger player on the global scene. And look, whether you like it or not, globalization is happening. And so a big global player allows companies that, let's say you're a UK company and you want to break into the US market, having a company that has good presence there, that is a UK based platform, but can file the Form C for you and run the financial promotion in the US. That's a good thing. That's a strong thing. So this is what I'm hoping will happen as part of their merger, is that they will, become a much more global platform to allow companies to think much more globally as they're fundraising, and to be able to not just market to a UK based audience, but to do it globally as well. I touched on it, and I will kind of go into a little bit more detail. I won't spend too long on it because I haven't got much longer. But SEIS and EIS, this is what's driven these two tax relief schemes, is what's driven the equity crowdfunding scene here in the UK and made us a global leader. because we didn't have necessarily have the idea first, although we kind of arguably did. If you look at the likes of Kickstarter, they were looking at effectively raising equity in the early days of running a rewards platform, and of course the SEC quickly shut any sort of potential of that down. And so a combination of our regulatory framework kind of allowing for it, although we really tested the boundaries of that framework in the early days, the FCA quite quickly worked with the platforms to come up with a distinctive framework. We were the first country in the world to do that. But what really poured fuel on that fire is SEIS and EIS. So these are two very generous income tax relief programs for investors into early stage companies. If you're younger than 2 years old, and you and that's trading, i.e. from your first actual sale, you can an investor into your company can claim back 50% of their investment from HMRC on last year's or this year's income tax bill. More to that, there is also income tax relief. If the company goes on to fail and you lose all of your money, there's some downside protection. So a high rate taxpayer will also then be protected by another 45% of their investment on their loss. So a kind of crude way of saying it is, for some investors, they're only risking 20 pence of every pound they're investing into an SEIS-based company. So you can see that's why it's fueling this this incredible investment into early stage companies. But it's only eligible for companies that operate within the UK and for UK-based taxpayers. So as we become a global platform, obviously, this is, as long as we can keep these schemes going. I mean, there was recently in the news that Rishi Sunak is thinking about addressing capital gains relief. The other benefit to SEIS is you also get a capital gains tax break. So if the company goes on to do well, you don't pay any capital gains tax on it. So it's kind of a triple benefit, if you will. So there's always been talk about whether the EIS and SEIS are going to be cut back or stopped entirely. But for whilst they're still there, this is what gives us the competitive advantage in the global market. So now is the time, whilst the US market is still quite nascent, whilst these tax relief schemes still exist, now is the time for us to really step up and be a global player and establish ourselves as such. So I think that's what, to me, wearing my rose-tinted glasses, being the optimist, that's what I think the merger is going to give us. Just for those of you that are wondering about EIS, very similar to SEIS, just for slightly later stage companies, you get a 7-year time limit rather than 2. It actually goes up to 10 years in some instances if you're a more knowledge intensive company. But I won't go into the details of that now. That's a subject for an entire webinar in itself. But the limits are slightly lower. The limits are slightly lower. You can invest up to 7 million in any given year with a lifetime limit of 20 million or 21 million, I think it is. And your tax relief is 30% rather than 50%. And your loss reliefs work slightly differently. So it's more realistically a high rate taxpayer is risking 50 pence in every pound rather than 20 pence, just to give you some sort of context. Okay. So where are the opportunities? Where are the risks of this merger? This is whatever happens, it's going to become a more powerful marketing platform. So, I guess when you've got two players at relative parity, when they do have something that is a bit of a secret sauce, they don't want to share it just in case the other one finds out about it and starts to copy. So historically, the marketing has been quite a closed shop. We haven't been able to see as marketers ourselves, we haven't been able to really dive into the platform and see how it's working. So my hope is that by being the established dominant sort of player, that there's less sort of threats for them to sort of share that information more publicly, or at least, not necessarily publicly, but with their clients. We like Seedrs secondary marketplace. There haven't been enough exits yet in equity crowdfunding. We'd like to see more. So what the secondary marketplace does, it just brings a bit more liquidity. If someone wants to invest into another company, they can liquidate one of their older shareholdings in order to invest in a new company coming through. So that kind of feeds the cycle, so to speak. So we hope that the new super platform will adopt Seedrs secondary market. I think they'd be mad not to. We also think that if the platform is more aligned, it's a bit more of a kind of VC model where they're aligned on the success of the exit, that would be better for the ecosystem as a whole. So Seedrs currently does that, Crowdcube doesn't. So there's hope there that they adopt sort of Seedrs model rather than rather than Crowdcubes. And you know what we hope to sort of see is more of a kind of marketing toolkit that that entrepreneurs can use when they're raising, or partners, you know, like Tribe First or any of the other sort of crowdfunding support partners. If you had a marketing, you know, if you think about it from a platform perspective, you know, they hold lots of investor data, and you know, it's incredibly powerful and valuable as well. And you can understand why they wouldn't want to just give kind of unadulterated access to what is, you know, the core of their value. But being able to give sort of better marketing tools to people, you know, there was talk, the press release when they talked about the merger was that they were hoping to become a private equity marketplace. So that tells me that they're probably going to provide more tools that kind of can be maybe more self-served, to allow them to scale much more, because that's also been part of the issue with them scaling previously as two separate platforms. You know, they haven't achieved the scale they wanted to because they've had to over-service directly too many of the clients. We hope that they will give the ability to reflect the entire round. This goes back to my point from earlier that, you know, there's interdependencies with the rest of the equity of the rest of the private equity market. So if you, you know, Crowdcube and Seedrs have approached this slightly differently historically. Crowdcube takes the view that they're only going to show anything that has been coming as an investment since the company was in private live on Crowdcube. But of course, fundraising rounds don't really happen like that. You know, some comes in via equity, via private equity or venture capital. Some comes in via angels. You know, as long as it is a distinct round, i.e., you know, the terms are the same, the equity being offered are the same, the shares on offer are the same. You know, we feel our opinion is that it should be able to be reflected as part of the entire round. So there's a hope here that you know, the merger of the two platforms makes them sort of see themselves as a cog in a much larger private equity landscape, and therefore the platform functionality is reflective of that, and a variety of instruments as well. And again, because we hope they're becoming more of a private equity marketplace, not just offering straight up equity. You know, we've seen both platforms offer future fund rounds. Obviously, future funds are a temporary thing, but you know, there are similar kind of things with convertible notes. You know, maybe we'll offer some kind of safe in the future. They've done bonds at some stage. You know, bonds for the right company is probably still attractive to some investors. So we want to see, you know, a variety of instruments and not just, you know, straight up equity, so that founders have much more choice over which way they can go as well. We don't want to see paying for sort of basic marketing, charging for basic marketing. We can understand platforms wanting to de-risk some of their kind of use of their platform, but would rather sort of see, you know, upfront fees or something like that than actually paying for basic marketing. You know, what you found on Seedrs is that you have to kind of pay for even the most basic of marketing to get it in front of their users. Yes, you get kind of in one of their newsletters, but it's so low down and such a small piece that it's pretty meaningless. You know, the investment only really starts to kick in once you actually pay for some of their marketing packages. And so we don't, you know, we think at least a basic level of support should be included. Obviously, if you're paying for, you know, a dedicated email that goes out to the entire community, yeah, of course you can upsell that. That should be something that maybe is charged for. It's a bit more exclusive. And the other thing we don't want to see sort of fixed high percentage cost, because, you know, this is the danger of you know, having one dominant player, is that, you know, they can especially when you're combining two companies that aren't profitable. Obviously, there's some hope that combining the two forces will, you know, economies of scale and merging some of their compliance departments and back office and what have you will actually allow them just to become sort of profitable by default. And I think by sort of assessing their finances, it looks like that probably would happen anyway. But you know, the danger is that they sort of just slap on a big high percentage cost. Of course, if you're going to become a true private equity marketplace, which is what they intend to do, then you need to be much more flexible with the way you charge, and charge for, you know, things that founders are using when they're using it, not charging for things they don't need. Because that's the danger, really, is kind of you try and make it one size fits all, and then it actually only services a small proportion of the marketplace and not everyone. So that's what we hope to see. So just wrapping up, I just want to close with a success story that we've had that probably wouldn't have happened if it wasn't for, you know, equity crowdfunding. this company Cargo, they recently announced this week that they were the first autonomous vehicle, semi-autonomous at the moment, because that's the way that the UK regulations are happening, but they are a fully autonomous vehicle that's controlled by a control center. And they were the first UK road legal car autonomous vehicle to be on UK roads. They beat the likes of Tesla, Google, Dyson attempted it and failed. They beat all of these people to become the first company to do it. And they did it by raising £300,000 on Crowdcube about 3 years ago. And since then, they've only raised private investment from a few private investors, when their competitors are raising in the billions to try and try and achieve, and actually ultimately fail the same thing. That is the power of British innovation. That is the power of equity crowdfunding if it's done right. They still needed other parts of the fundraising landscape. They've had grant funding. They've had R&D tax credits. They've had angel investors come on board. There's talk with corporate venture capital and various other sort of venture capital groups to do the next raise of funding to take to the next level. But they have got themselves this far without having to take on venture capital financing, which is just incredible. And that's the power of the current scene. And that's what we don't want to lose with this merger. We want to empower more cargos to be able to do that. So yeah, hopefully that's given you a kind of snapshot of the scene, of what's going on. And where we see the opportunities with the merger and what could come. So yeah, I look forward to answering any of your questions.
Awesome. That car there, John, was that guy's name something like William Succi or
William Sachiti? Yes, he spoke at one of your the Bournemouth event.
Yeah, that's right. But literally, I reckon about 3 years ago. Funnily enough,
it was not long after his raise.
Yeah, because I saw his video pop up on a LinkedIn post. Maybe it was last week or something like that, and I remember thinking, "God, I haven't heard of him for a while." But I remember that design from 3 years ago, and he's clearly been putting the hard work in the background, and would still, I'm assuming, own a significant percentage of his company. Then, if he's gone about it the way you said.
Well, look, this is the key thing. I mean, I won't disclose exactly how much, but he's been able to retain a very large percentage, and it's not just savvy entrepreneurialism, but it's why it's going to work. It's why it's going to work over some of the other incumbents. I've seen some of the other autonomous vehicle companies. The founders don't own their company anymore. The venture capitalists own them, and own them with preference shares to the point where they could still have quite a significant exit, and the founders will not see any return from that exit. It's just sacrilegious. And so that's what William's been able to achieve. But he's not just done it on his own. He's done it through the power of people. And of course, all of those backers that believed in him and shared his vision in the early days, they're going to be very handsomely rewarded as well. And that's so that's what equity crowdfunding's done. Is we use this word democratize all the time, but it has democratized access to these potential unicorn companies, right? And I genuinely don't think he would have done it. I don't think he would have beat all the others if he hadn't taken that particular route.
Yeah, super interesting. And, we've covered a whole lot now over the last, 5, 6, 7 days or so, 7 working days or so. I think we've covered startup loans. We've got startup loans again with, when are we doing that one? I think we're doing that on Thursday. So we're doing startup loans again with startup loans this time. We had Transmit before, but we've got startup loans, the director of startup loans coming in and talking about that. On Thursday, we had Stuart Chapman, who's the founder of Draper Esprit Venture Capital that you might know. We had a great chat with Stuart. I think he spent like £10 million a week investing in like one a month, literally. And then we had Piers Linney talking a little bit about crowdfunding and his experience with Atherton Bikes, which I think we're up to 1.2, 1.3, I think, currently raising. And then we also had Stepan Galiev, who's the investment director for Dragon's Den, talking as well. So what have we missed? What have we missed? What do we need to cover since then? We've covered a whole bunch of different stuff. What about yourself? You've got anything else? You mentioned before talking about crowdfunding accelerators and stuff. For a number of our audience here, where would they look for that kind of scheme at the moment? Because I know you've got Grant Thornton, and I know you've worked with Virgin Startup like myself as well. Anything happening towards the end of this year, or probably looking at the beginning of next year now, are we?
Yeah, so we obviously the pandemic put pay to any sort of face-to-face accelerators that we used to run. So CrowdBoost was kind of postponed potentially indefinitely. I don't know. Something's coming next, but I'm not allowed to talk about it. So I'll let the Virgin Startup team kind of promote that in due course. But there are programs are going to start again, whether they're virtual for the short term or you know, what have you. I mean, the best thing to do is probably just follow me on Twitter or connect with me on LinkedIn, and I will obviously post updates as soon as I have them. We are running a virtual. Tribe First is running a virtual accelerator. So obviously there was kind of a gap there that the company still wanted to move forward. So and we got the process. We know it works. So we're running that as a virtual accelerator at the moment. So anyone raising anywhere between 150,000 and say sort of 500,000 is probably quite well suited to that program.
Okay.
And again, just hook up with me on LinkedIn, or visit www.tribefirst.co.uk and sort of submit an inquiry there. And you know, it's given us time to kind of reflect as well. You know, part of you know, the marketing and fundraising thing is obviously quite important, but actually having access to capital is also very important. So, you know, Tribe First, we are raising our own fund at the moment. So any investors that are that like the kind of model that we have, that are potentially interested in being able to tap into some of these amazing startups that we work with, they'll be able to invest in our fund from sort of £10,000 upwards.
Cool, exciting, mate.
Yeah, so that's pretty exciting news. And loads of obviously other exciting stuff that's coming that I'm not allowed to talk about. But like I say, just follow me and you'll hear about it.
Such is the nature of your industry, funnily enough.
Indeed.
I've posted up your LinkedIn. I've also posted up earlier, if people scroll up, and this will be on the replay, tribefirst.co.uk as well. Got questions and stuff, so I know we're running out of time, so I will dive into those now for you. Samantha from findingstartups.com asks, if you don't live in the UK, can you still use UK crowdfunding platforms?
So yes, absolutely. Yeah. So it depends where your company is incorporated. If it's incorporated in the UK, then that's absolutely fine. At the moment, you need to be in a country that they serve. So if they've historically run campaigns in that country, then you're okay. So there's a slew of them. There's, you know, Germany, Portugal, Holland, Belgium and France, kind of. Spain, obviously, is a very good one. Poland. There's a few of them where they've had quite a few campaigns now, so it's relatively easy. US, UK, obviously. Ireland as well has its own regulations, but you can just about crowdfund. But you know, it doesn't need to be your parent company, but it's actually very easy to set up a UK parent company and sit, you know, wherever you are based in the world, sit, you know, that company underneath the UK parent company. There are benefits to doing that. It doesn't automatically qualify you for EIS and SEIS because it's where your trading activity takes place. But as long as some of your trading activity is going to happen in the UK, then you should still qualify. So there's lots of reasons why it's advantageous setting up in the UK. Similar for R&D tax credits. If you're doing, you know, quite intensive, novel, innovative work, then you could qualify for R&D tax credits as well, or even Innovate UK grants. So there's lots of benefits to being set up in the UK. Okay, perfect.
Chris from the Fast Film Administration asks, we in the film industry are finding that HMRC are not supporting EIS schemes by pushing back on applications if you cannot, in early days, demonstrate a large infrastructure with lots of PAYE staff, which is self-defeating. Have you come across this at all?
Yeah, so yes, because the film industry has historically created special purpose vehicles which own the IP of that film.
Yeah,
and so obviously it's a bit chicken and the egg, because unless you're, you know, unless you're a kind of established studio, you know, you're not going to have all of those kind of structures in place that's going to be able to demonstrate risk around that film. So what I'm just checking the movie that was done on Syndicate Room. So was it Salty? No, it's called something else. Can't remember what it's called. Gunshy. That's it. Simon West's movie Gunshy. So he raised 1.8 million in Syndicate Room back when Syndicate Room was an equity crowdfunding platform itself. And you know that, and because Simon West is obviously a very established director, you know, it kind of worked for him. Worked as a campaign. The only time I've ever seen it work outside of that is to actually crowdfund the studio, not the SPV. And so I think that's probably going to be a pattern that we see going forwards. There's nothing stopping you doing that, though. You know, set up the studio, you know, have a bunch of IP that you want to run and operate through that studio, and have distinct raises as the studio kind of grows in sort of stature. You know, I don't see any reason why that can't be a model for filmmaking that's much more HMRC friendly, shall we say.
Dr. Joward, who's in the dental industry, asks, what is the ideal stage for a business to make contact with you, John, at Tribe First? And she also puts, can you use SEIS to pay into your own separate company and get tax relief?
So I'll answer the SEIS question first. So SEIS is only non-connected investors. So you're not allowed to do it into your own company. You can't go up or down either. So you can't, parents and children can't do it, but you can go sideways. So uncles and siblings can invest in your company. I think I'm fairly sure, but I mean, I'm not a tax advisor, so don't take that with the tax advisor. But that's pretty much the gist of it. So best stage to engage Tribe First. We, like I say, on the accelerator side of things, we'll support companies from 150,000 to 500,000 raise. That sort of ballpark. Can sometimes be more. We're doing a plus £1 million raise on our accelerator, but it's a bit of an outlier. It tends to be, or the managed service. So we also you can outsource a lot of your campaign management to us. We'll run a PR campaign. We'll shoot your pitch video. We'll, you know, liaise with the platform and do a lot of the kind of heavy lifting around your campaign. That's typically companies raising in excess of, say, sort of 300, 400,000 up to, I mean, our biggest campaign is probably about 7 million, but typically probably about sort of 2-3 million. So it's not necessarily so much how you raise, because we do cover that full spectrum. It's more what stage you're at, which takes me back to my previous slides, which hopefully you'll be able to look back at if you watch it back. You know, it covers that sort of pre-revenue up to sort of private equity stage. You know, you need to have proven the concept in some capacity. You probably need to have your first 20% lined up. You know, you need to be investment ready before you can work with us. We tend to just reject most pitches that don't have at least 20% of their lead investment already lined up. And so whilst we work on refining your pitch, you kind of need to be at that investment ready stage really to work with us.
Great, thanks. Paul from Maton Media says, great presentation. Thanks, John. Is there a chance you can give out your earlier slides with organizations on? You will be able to watch the replay as well. As I say, in about 24 hours, we tend to get them back from air meets and post them up on the link that I've put in there at festivalofenterprise.co.uk. And I've posted up John's website and his LinkedIn, so you can connect with him on that. Chris says, indeed, you've summed it up beautifully. Thank you. The SPV to protect the IP is the issue, but HMRC doesn't like the idea of an SPV as the maintainer isn't a viable business which one intends to grow. A conundrum indeed. Well, we wish you all the best, Chris, with that indeed. So exciting times. Look, ran over, which is probably my fault as usual, but so exciting times for you and the industry, really. So we could end up with Seed Cube or a Crowd Seed or something like that coming our way soon.
Yeah. I don't see any reason why the CMA would block it. So I expect we will. So it's exciting times. Potential, you know, nerve-wracking times for a lot of the crowdfunding service providers. You know, where do they fit in this new world? But look, it's an optimistic thing. It's a sign of the market maturing. You know, for being a bit cynical about it, it kind of had to happen. You know, they after 10 years, an equity crowdfunding platform has failed to achieve profitability. So, you know, I think it's better than the alternative, which is one of them failing. So, you know, this is a very positive move by an industry that is maturing, and yeah, I'm really excited to be a part of it.
Yeah, I bet. And look, if you're looking at your funding journey, what stage of that you're at in your business. As I say, we've had sessions with venture capital, Stuart Chapman from Draper Esprit. We've had Stepan Galiev, investment director at Dragon's Den. We had yesterday Magnus Grimmeland from Antler. As well, who are an early stage VC. And it's interesting, all three of them, before me even asking them the question, all said independently that they've never seen so many, like the quantity of businesses looking for investment has increased this year. But equally, they thought that the quality of entrepreneurs had matured as well over the previous years. Do you agree with that, John?
100%. Yeah, crisis breeds opportunity, doesn't it? Entrepreneurs that had a side hustle that's now their main hustle. Lots of time during lockdown to sit and think and come up with great ideas, or further establish existing ones. Yeah, I mean, it's blowing up out there. It really is. It's exciting.
Yeah. It is. Okay. And it should be exciting for all you guys watching this as well. So as I say, I'm back at 7 o'clock. We're trialing an evening session because we're going to be doing more of these festivals throughout 2021 as well. And we saw some positive news last night from our great esteemed leader, Boris, with regards to indoor events. And we hope to see that continue. But in the meantime, we are going to be bringing virtual events. So come and join me at 7 p.m. Live from Hawaii. Well, I'm in Poole and Dorset, but Laura De Benedito is going to be talking the 6 habits, practical tools for bringing your business dreams to life. Different habits to determine our journey through business and life, and explain how we can begin to master those habits. A little bit of a different one. We're trying to give you as broad a spectrum as possible when it comes to helping you and your business start up and scale up. So John, look, thank you once again for joining us here. Much appreciated. Replay, as I say, will be available. And if you look at the chat, we've got the right links there to connect with John and to connect with Tribe First as well. Thank you, Julie. And thank you, Dr. Jawad, and everybody else who's posting up nice comments. So thank you and enjoy the rest of your week, everybody.
Thanks. Bye.